So thank everyone for watching our summary of our appraisal report. My name is Alex, and I'll just jump right in. So our house that we picked was 419 Old Rock House Road. This is a picture right here. It's a single-family home built in 1999. It's 5 bedrooms, 4.5 bathrooms, 4,200 square feet. It has a 2-car garage, and it sits on a 0.53 acre lot, and it's located in Greenville, South Carolina. And now we'll move into the sales comparison approach, where we pick some comparable properties. For property number 1, it is located at 59 Grand Vista Drive in Greenville. It's 4 bedrooms, 4.5 bathrooms. It also is 4,200 square feet. The lot size is 0.34 acres, so a little smaller than our subject property, and it's sold for $1.11 million, built in 2018 also. Moving on to comparable property number 2, it is at 40 Paddington Avenue, also in Greenville. It's 5 bedrooms, 5 bathrooms, slightly bigger at 4,400 square feet. Its lot size was, again, a little bit smaller at 0.36 acres, built in 2014, and it sold for $693,965. And moving on to number 3, 1103 North Main Street in Greenville. It's a 4-bedroom, 4-bath house, same size as our comparable property at 4,200 square feet. It is, again, even smaller at 0.27 acres, built in 1943, and it sold for $589,000. And Gracie is going to continue with the next comparable properties.
Okay, so my name is Gracie Heron, and we have a few more comparables. This is property number 4. It's a 1963 built home. It's at 126 Lake Crest Drive. It sold for right at $536,000. It's around the same acreage. It has 5 bedrooms, 4.5 baths, just like our subject house, and has around the same square footage. This is property number 5. It is a 1970 home. It's 4 bedroom, 3 baths, so slightly smaller and has slightly smaller square footage, but it does sit on a larger lot. It's located at 201 Arundel Road, and it sold for $422,000. It's located in the same school district and has on the same size attached garage. And then this is comparable property number 6. It is located at 7 Rockmount Road. It sold for right at $257,000. It also has a 2-car garage, very similar square footage. It does have a slightly larger acre that it sits on. It was built in 1964 and is a 5-bedroom, 3-bathroom home. It is also in the same school district though, and was updated in 2019.
So this is just a chart outlining some key statistics we found that helped us with our analysis. So it outlines the price per square foot, year built, number of bedrooms, bathrooms, the square footage, and lot size. And we found the minimum, average, median, and maximum for our comparable properties. And now we're going to just outline what adjustments we took during our calculations for the sales comparison approach. So I'll outline the first 4, and then Gracie will talk about the last 4. So the first adjustment we made was based on square footage, and our subject property was 4,200 square feet. So in order to adjust the comparable properties, we took the average of the price per square foot and then multiplied that average by the difference in floor size between each comparable and the subject property. To adjust for year built, we used DQYJD's historical home prices data, which are inflation adjusted prices for each home. And we took the price for the given year and adjusted it accordingly based on our subject property's year built. For bedrooms, we used Zillow's South Carolina market overview, which lists the median price of 4-bedroom homes and 5-bedroom homes in South Carolina. So the price for 5+ bedroom homes differed from 4-bedroom homes by about $52,000. So in order to hopefully just account for 5-bedroom homes, not 6+, we lowered that number to $35,000 for our adjustment. For bathrooms, we found that the average cost to add a bathroom was about $25,000, and that the return on investment for those was about 47%. So doing that calculation, we found that adding a bathroom would increase the value of a home by about $11,750. And Gracie is going to talk about the last 4.
Okay, so then we had to make an adjustment for the land size because they had differing acreage lots that they sat on. And so to be able to do this, I found a nearby lot that had recently sold. It was a little over an acre, and so I adjusted that lot to a per acre value, and it was right near Paris Mountain State Park, which is right where our subject house is located in. So I ended up finding that 1 acre in the area is around $28,900. And so I then made adjustments accordingly in order to bring the comparables to the same standard as our subject property's home with the 0.53 acreage lot. For the number of garages, I found an article on Home Guide that was updated in 2020 that gave some information on around the average size of a 1 garage, 2 garage, and 3 garage as far as square footage goes. And it also said that a garage is approximately worth $49 per square feet. And so I used these to make the adjustments on the 2 properties that had a 1-car garage and a 3-car garage, since our property has a 2-car garage, and I made those adjustments accordingly based on the $49 per square foot. For the time from sales date, I found on Zillow that the average increase in South Carolina currently is about 4% per year for a home. And so I then divided this by 365 days so that I could get a day-by-day basis on how much there was an increase per day. And then I calculated the number of days that it had been from the sales date, since some of them had been sold a while ago. And so we calculated that to adjust for the appreciation that the homes may have since that sale occurred. And so we added that back in there. And then we also analyzed the school district. According to Zillow, they were all in the same school district, and there was also a link directly correlated with Zillow that took you to a website called greatschools.org, and it showed that while they are all in the same school district, but some of the comparable properties were assigned different elementary, middle, and high schools to attend. But I looked up all the schools just to see what their ratings were, and all the ratings were equal amongst all the schools in the district. And so we did not feel that it was necessary to make an adjustment based on the school district. And so we calculated all the adjustments accordingly and found that the average price, or a good estimated appraisal value using this method, was $670,276.70. We then weighted this in our final approach value as 50% because this is a good estimate of homes in the area, but then it also includes the other values, even though they might not be as applicable to a single family home as this one is. And one of the negatives about this part of the project was we did get a fairly higher estimated value than a few of the other approaches got, but I feel that the other approaches were able to compensate for that. And one of the positives was that we used a lot of different adjustments, and so that way we could create the most accurate report possible. This was also could be impacted by the coronavirus right now. It is kind of unlikely that the seller is going to receive a price this high at the moment because there are a lot of issues in the real estate market, obviously, because of the coronavirus impacts that are currently happening and the stay-at-home orders that are happening. And so this will affect the housing, which we will discuss a little bit more later. But for now, I'm going to turn it over to Mary Catherine to talk about our second appraisal method.
I'm Mary Catherine Kellum, and I'll be presenting the second approach we used, which was the cost approach. So for the cost approach, we began with a construction cost calculator called Cost to Build LLC, and we input the square footage of our subject property, 4,200 square feet, as well as the unique specifications of our property. And Cost to Build LLC gave us an estimate of $291,835 to build a replica property of the same utility today, including both the material and the labor costs. On the next slide, the entire cost approach calculation is outlined. So after we found the estimated reproduction cost of the improvements, we estimated the accrued depreciation for our 21-year-old subject property. We used a 100-year useful life for the property, which was estimated based off of the useful life of similar properties in the upstate of South Carolina made of similar construction materials without any major improvements. When we used a straight line depreciation method and a $0 residual value, we estimated the accrued depreciation for our 21-year-old property to be $61,285. and that gave us the total depreciated cost of our building improvements. After we calculated the depreciated cost of the improvements, we added back the value of the site of the property, and we used a Zillow estimate of a 1-acre plot in the same zip code as our subject property that sold for $28,900, and then reflected our 0.53 acre site of our land to give an estimated value of the site of $15,317. To get the final indicated value by the cost approach, we added the depreciated cost of the building improvements and the estimated value of the site together and got $245,866.65 as our final value by the cost approach. For our final reconciled value, we weighted the cost approach 30% because although this value was based on the real cost of the construction and land in this area's zip code, which is definitely a positive for this approach, since it reflects the actual area in which the subject property is located, the cost approach is typically used for more unique properties, such as government facilities like libraries or educational institutions like Clemson University, and it's not typically used for a single family home, which is what our subject property is, so this is a negative related to the cost approach. Therefore, we chose 30% to reflect the accuracy of the construction cost, but to keep in mind that this approach is typically not used for a common single-family home like our subject property. On a larger scale, the implications of the coronavirus definitely impact cost properties, specifically related to the supply chain distribution. As it was mentioned earlier, most cost properties have specific construction materials and unique made-to-order specifications since they are more unique properties, and many of these supply chains are being disrupted at this time, specifically the global suppliers in Asia. Many cost properties cannot continue building because they cannot get these construction materials from another supplier since they are unique materials, and it's unclear when the supply chain will be back to normal. A further analysis can be conducted on this supply chain disruption after the coronavirus pandemic concludes to state whether the supply chain will be back to normal and discuss the complete implications of the coronavirus on the supply chain.
I am Zoe Iorio, and I'm going to discuss the third method of appraisal, the income approach. So the foundation of the income approach is net operating income, and the full calculation is seen on this slide here. The first thing that I did was estimate the monthly rent for a 5-bedroom home. I based this off of a 3-bedroom home. So I divided the monthly rent of a 3-bedroom home by 3 and then multiplied it by 5 to adjust for our 5-bedroom home. This was based off rental prices in Greenville. And so that yielded a PGI of $24,000. Vacancy and collection costs were calculated as a percentage of PGI, and operating income or operating expenses were based on other comparable properties. We did not expect any miscellaneous income or additional capital expenditures on this house, and so those were estimated at 0. Once the calculation is complete, it yielded a net operating income of $20,280. So the income approach has 2 methods within it. The first method is the direct capitalization method. This requires estimating a cap rate. I estimated our cap rate at 6.75% based on 2 counties in the average of 2 counties in South Carolina. So when you plug these into the formula for direct capitalization, it is the NOI divided by the cap rate, which yielded an indicated property value of $300,444. The second approach within the income approach is the discounted cash flows method. This one assumes a longer holding period. In this calculation, it assumes a 10-year holding period. So a primary part of the discounted cash flows method is taking all of the cash flows you expect to make from the property and discounting them back to their present value. In order to do this, a discount rate was required. This rate was estimated based on the average mortgage rate in Greenville, South Carolina. And so that is where 3.575 came from. This discount rate was then used to convert all of the cash flows to their present value. And then these numbers were added together, resulting in an indicated value of $379,908. Each of the 2 methods were rated at 10% each because it is primarily used for investment properties such as apartment buildings or commercial units that are leased out. We still wanted to estimate it so that we could get an idea of its value as a investment property in Greenville, and all of our numbers were based on the Greenville area. So we wanted to reflect the lower weights because our property wouldn't necessarily be used as an investment property, but we still wanted to estimate it. And on a larger scale, everything going on with COVID could lead tenants to be unable to make their rental payments. This impacts landlords as well, because many landlords depend on those rental payments to meet their own mortgage payments. Furthermore, vacancies and losses might increase because many landlords will be unable to fill their properties with a lack of open houses and other things. Finally, when we reconciled all of the individual values, we got a value of $476,933.68. This value is very similar to the value that is quoted on Zillow, which is definitely a good thing. However, some of the cons are that each method that we did yielded very, very different values. We tried to accommodate for this by weighting the values that we thought were most applicable at a higher percentage than we did the other values. So moving on, Taylor and Allison are going to talk more about the pandemic's impacts on the real estate market.
So my name's Allison Zarella, and for our project, I worked on the effects of the coronavirus. So as everyone is aware, our country is in the midst of a pandemic, the coronavirus, and this pandemic has two major effects on us right now, and that is that it's a global health crisis and it's also harming the overall economy. And these two crises sort of oppose each other because in order to go out, help stimulate the economy, people would have to leave their homes and go to local restaurants and businesses, and that is just something that we're unable to do right now due to the extremely contagious virus and the rules of social distancing and quarantining. So although this is similar to the 2007-2008 recession, during that time there was only the period of economic damage. There was not also a global health crisis, so that would be the difference between these two situations. But despite this very bleak and scary situation, our government has made some action. Some of the acts that they have done, so they've cut interest rates to 0%. They've agreed to purchase $700 billion in bonds and securities. And then one of the biggest things I think is that President Trump signed a bipartisan $2 trillion economic relief plan. Additionally, taxpayers will also be receiving rebates, and these rebates will just depend on marital status, how many children they have, and how much income they receive. And the government's hoping that by giving taxpayers rebates, they will be able to stimulate the economy in whatever way they can. Additionally, the IRS is extending tax returns for 2019 until July. So this will give people more time to file their tax returns during this extremely stressful situation. And the governmental action being taken right now is similar to that taken during the 2008 recession by President Bush when he issued the Economic Stimulus Act, which gave taxpayers rebates to go and help boost the economy, which is kind of what's happening now. So a big question that many people are asking is, will this lead to a recession like the one we experienced in 2008? And the reason people are thinking this is because the stock markets have been seriously fluctuating. And due to this, many investors have pulled their money out of risky stock investments and switched to bonds, which are more stable instead. And this is extremely common with people who are nearing retirement, because people getting close to retirement obviously do not want to have all their money invested in risky stocks, especially during a pandemic when the stock markets are very volatile. Additionally, 3.3 million people have filed for unemployment, and this is a major result that all non-essential businesses are closing. So when people, especially working in the restaurant industry, hospitality industry, tourism industries, they just are not even able to go into work right now, and as a result, many of their employers have laid them off. And this is sort of similar to the 2008 crisis when the Dow Jones Industrial Index lost more than half of its value, and as a result, many Americans did lose significant investments. So next I'll be talking a little bit about the three movies that we studied in this course, which are The Big Short, Small Enough to Jail, and Inside Job. And each of these movies focuses on the 2007-2008 financial crisis. So the housing market crash when Americans took out mortgages they could not afford, and the Federal Reserve was keeping interest rates low, which was then supporting subprime mortgages. And then as a result, the housing bubble emerged. However, unlike the coronavirus pandemic, this housing market crash was sort of predictable by very knowledgeable financial analysts. For example, as we saw in the film The Big Short, financial analyst Michael Burry was able to determine that CDOs were just mortgages given to Americans with poor credit scores, and rating agencies had not properly rated the riskiness of these securities. So although not everyone knew this was going to happen, it was technically a predictable situation that some people did know and think was going to happen, as opposed to the coronavirus pandemic was truly unpredictable. No one could have guessed how rampant it would become, how much it would spread, and how much of a true crisis it would become in our nation. So now I'll turn it over to Taylor to talk about how coronavirus is affecting the housing market.
Hi, my name is Taylor Noor, and I also study the coronavirus. Now I'm going to discuss the coronavirus in the housing market. As one would normally see their potential home through an open house, this has been negatively impacted due to the virus. Being in quarantine has restricted open houses from occurring, but to supplement this, virtual tours have become more popular. Now it is not ideal as home buyers want to see their potential property in person. It is a temporary fix to this issue. Another impact is mortgage rates have fallen. This is because of investors switching out of the stock market because of its volatility to the bond market because it's more secure. The demand for bonds has increased, causing the price of bonds to also increase. When bond prices increase, this translates to mortgage rates and yields falling. Another factor in the housing market that is occurring is the demand for luxury homes. There's been a less demand for luxury homes currently. This is in part due to the uncertainty in the economy. People have less discretionary money and are prioritizing how they spend it. Lastly, as discussed earlier, the global supply chain has been impacted. This decreases the shipments coming from Asian countries, in turn impacts the housing market by slowing down the building process. Now I'm going to look at the impact of Clemson and the surrounding areas. Rental properties may struggle. Tenants may have a harder time paying their rent. They may have lost their jobs, and that may directly impact their ability to pay their landlord. As Allison talked about earlier, 3.3 million Americans have filed for unemployment. On another note, Clemson is primarily a college town, so there will still be a demand for student housing in the area. As for single-family homes, all of this may cause the seller to take their home off the market in fear of receiving low offers or a low return on their home. However, buyers may still be looking. There will be many advantages of homes that will still remain if they're still available for sale. Next, the two graphs exhibit the average weekly mortgage rates declining. Because of this pandemic, these rates are lower than usual. These low rates may impact the home sales activities. Homes are a fixed asset. Buyers may see this as a more secure investment instead of investing into the financial markets because of their volatility right now. However, there may be less homes for sale because of all of this. On a positive note, this is unlike the previous drop in home sales due to the subprime mortgage crisis. This is not expected to last as long. The demand for housing was strong before the crisis, and hopefully it will recover fast. Our nation will come out of this pandemic and return to normal life. Just a matter of time. That is all we have. Thank you for watching our presentation.